Welcome. I am Marty Hendrick, a member of the marketing team at Portfolio Valuations Incorporated. The topic for today's webinar is 408B2, Are You Ready? The speakers for this presentation are David Hudak, Senior Consultant at PEI, and Jean Martone, Director of the Retirement Plans Consulting Group. David works with clients nationwide to provide investment consulting services for defined contribution, defined benefits, endowments, and foundation clients. Dave has been in the investment consulting industry since 1999 and with PEI since 2006. Jean has over 25 years of experience with employee benefit plans. She has a diverse background and includes benefit consulting as well as corporate benefit administration. Jean has been with PEI since 2006. The session will be recorded and available for distribution after the presentation. You are in listen-only mode. However, we do encourage you to send questions via the chat box up on your screen. And with that, here's Dave and Jean.
Thank you, Marty. Jean and I appreciate everyone taking some time this morning to join us for this presentation. We have a lot of good information to share with you. Jean is our in-house expert on plan fees. We have set up this in an interview-type format, and I'll be asking Jean questions as we go through the course of the presentation. With that being said, Jean, the industry's been talking about fee disclosure for several years. Who's ready and who's not?
We think the defined contribution community is more ready than the defined benefit community, and we're going to talk a little bit about that more as we get into the presentation.
Thank you. And before jumping in, let's just set our objective and our agenda for today. With 408B2 coming, our objective is to prepare you for fee disclosure, and we believe the best way to do that is to discuss a quick refresher on fiduciary duties. We'll dive into the new regulation and then share with you some best practices for how you can put a fiduciary process to work in meeting this new regulation, because again, the goal is really to prepare you for fee disclosure. By way of background, Portfolio Valuations is an independent investment consulting firm. This is our 20th year in business. We have always been completely independent of any other firms, completely unaffiliated. That business model has never changed since day one. We have over 180 clients, $26 billion in assets under advisement. We used to have a softball team. We won 2 games in 2 years, so we terminated that and decided to focus on what we do best, which is investment consulting. We've been evaluating retirement plan fees long before it became a popular trend. And certainly with the Retirement Plans Consulting Group led by Jean, her team focuses on understanding the vendor landscape for pension and defined contribution plans and their pricing models. Why is fee disclosure important? Well, it's important because as plan sponsors, you have a fiduciary duty, and you need to remember the exclusive benefit rule, that any action you take with regard to your plan needs to be in the best interest of your plan and your participants. So as you're hiring vendors to help you with your plan needs, you need to understand the fee structures paid to these organizations. ERISA says you need to make sure that these structures are reasonable. So one way to do that is by following a prudent process, remembering the 3 most important fiduciary rules: document, document, document. You need to explain what you did and why you did it. However, by going through this process, sometimes it can be challenging just to have the time to do that and also to understand the complexities of pricing models. So that's where partnering with an experienced expert can be helpful. So certainly during the course of this webinar, we're going to discuss best practices and how by taking some basic steps you can protect yourself. With that quick refresher behind us, let's look at this new regulation, 408B2. Jean, we've been talking about this as an industry for a couple of years now. When was this first seriously discussed?
It was actually discussed back in 2007, so it's been a long time. And as you can see from the first bullet on this slide, the interim final regulations were published back in July of 2010. And this is actually part of a 3-tiered approach to fee disclosure, which started with the changes to Schedule C of Form 5500 back in 2009. Then there is this piece, which is the plan sponsor fee disclosure, and then, as I'm sure most people on the phone are painfully aware of the participant fee disclosures that are effective this summer.
Now, is this a new regulation?
No. These rules have always been in effect. There's always been there's always been an obligation on the plan for the plan sponsor to determine that their fees are reasonable. There have always been prohibited transaction rules in place. What this has done is really put the responsibility on the covered service providers to disclose those fees to the plan sponsor.
To give this some context as well, let's look at who's actually going to be affected. Per the Department of Labor, there's 50,000 pension plans and almost 700,000 defined contribution plans that will be impacted by this regulation. So one of the things the Department of Labor stated in the final regulation when they issued it back in February is that they came about putting forth this regulation because they found that plan servicing agreements were becoming increasingly complex, and that these complexities have made it more difficult for plan sponsors to determine how much they were paying. So what the regulation is requiring is that covered service providers need to give plan sponsors information necessary to determine the reasonableness of plan fees and to identify any potential conflicts of interest. So this is sort of a new term, covered service provider. Jean, who would or wouldn't be considered a covered service provider?
If you look at the slide, it falls really basically under three broad categories. So if you are a fiduciary or an RIA to a plan, on a participant-directed plan if you're a provider of record-keeping and brokerage services, and then there's this kind of category of other, where those service providers who receive indirect compensation, even though they may not be a fiduciary, are going to be required to disclose their compensation. And this is probably going to be the area that's probably the most confusing and the most complex for some service providers to comply with.
So the regulation, as it's aiming to have better disclosure on fees and services, it buckets fees into two categories, direct compensation and indirect compensation. Jean, can you give us some examples of what might be considered indirect compensation and direct compensation?
Well, direct compensation is pretty straightforward. It's anything that's actually paid from the plan. So if you get an invoice for somebody and you have the trustee of that plan write a check to that provider, that's direct compensation. Indirect compensation is going to be a little bit more difficult. Things like sub-TA fees, 12B1 fees, those kind of fees fall under indirect compensation, but the complicated piece here is going to be things like finder's fees and things like that, which in the past you may not have been as aware of, are now going to be mandated to be disclosed to you. The other thing is that it's really important that, or it's required, that the covered service provider tell you if they are a fiduciary, and they have to tell you specifically with respect to what services they are a fiduciary. And the other thing that they have to tell you is how they are receiving this compensation. So there is a lot of responsibility on the covered service provider to meet the requirements of this regulation.
And we've included on this slide a link to the EBSA sample guide for plan fee disclosure. Unlike the participant fee disclosure where the DOL had a model template to use, the regulators have just come out with a guide saying that the disclosures need to meet these different elements, as Jean mentioned, talking about the services being provided, are they provided as a fiduciary, and then certainly what the compensation arrangements are. So certainly when you start getting some of these notices, it may be complicated to understand them. So when we talk about the fees in terms of what does need to be disclosed, it's really anything and everything related to your plan fees. We have found that some vendors have been proactive in providing this in anticipation of this final ruling. However, we've seen some providers are more ready than others, so it's certainly gone the full spectrum.
Yeah, and on the defined contribution side, I think that, most providers have been giving plan sponsors what they might call a fee transparency sheet. However, we know that most of them are amending those to comply with the regulation. Our understanding from most of the vendors that we work with is that you will be getting those sometime this month. Obviously, they have to be to you by July 1st. So if you haven't seen it, it should be coming very soon.
One other quick comment to be mindful of, if your plan uses an ERISA budget, sometimes they're also referred to as a plan expense reimbursement account or a plan expense account, there may be some indirect compensation that needs to be disclosed. So it's not yet clear what does or what does not need to be disclosed. However, I wanted to make that comment so if you have this type of arrangement, you're aware that there might need to be some disclosures forthcoming. So since some of the service providers are more prepared than others, the question is, what happens if one of your providers doesn't give you this disclosure? What the regulation states is if you don't get it, it could be considered what's known as a prohibited transaction. And obviously that's something you want to avoid. Penalties for prohibited transactions include excise taxes and or civil penalties as a percentage involved in the transaction. In this case with the 408B2 regulation, the service provider would incur a 15% excise tax each year until that issue is corrected. So it's really in the service provider's best interest to get this information to you. And if you don't get that regulation, that notice on disclosure, and you ask for it specifically in writing, that vendor has 90 days to comply, or you have to terminate that relationship, and you also have to report them to the DOL.
Yeah, so it is in the covered service provider's best interest to get you this information because they are going to be subject to the excise tax.
Now, as we close this section on the overview of the regulation, remember, it's your fiduciary duty to understand your fees and the reasonableness of those fees. This is not anything new. What's different with this regulation is now the service providers need to give you this information rather than you go to them and request it from them. As we transition to the next segment of our presentation, let's just talk about some issues that we're seeing. Gene, can you speak specifically to things we've seen with pension plans and DC plans?
Well, I think on the defined contribution side, as I said before, if you are with a bundled service provider, they're ready. You may not have gotten the final 408B2 disclosure from them yet, but they are going to be ready. They are going to be in compliance. I think where it might get a little bit more complicated is, for example, if you are using an RIA who has told you they are not a fiduciary, however, they are receiving indirect compensation, they are required to comply with this notification. And that RIA, however, could be performing some fiduciary duties. So it's really important for you to make a list of all your service providers and send something to them in writing requesting them to tell you whether they are considered a covered service provider. If they don't consider themselves, why not? And what kind of direct and, more importantly, it's the indirect compensation or the compensation between related parties that is going to be a challenge to disclose. We talked about this, at some of our prep sessions, is perhaps starting with your 2010 Schedule C. Even though the requirements are a little bit different, that will at least start to give you an idea of who, if you don't know off the top of your head who all the service providers could be, who you might need to reach out to say, hey, are you going to send me a service provider? The other thing that we've seen is on the defined benefit side, we've seen some of the initial sample or proposed disclosures from some discretionary investment managers, and some of the ERISA attorneys that we partner with have been a little bit disappointed and feel that some of these disclosures do not meet the requirements. So again, I think on the defined benefit side, there are going to be a lot more challenges because this is just, you don't typically talk about fees and fee disclosure and fee benchmarking like we've been on the defined contribution side for the last several years.
So when you talk about fees, and one of the assumptions that's been in the industry for a number of years among plan sponsors and some participants is this belief that these plans are actually free, but from the standpoint that they weren't actually writing a check to pay for planned services. But if you apply the Tin Staffel principle, there's no such thing as a free lunch. It's being paid somewhere by someone. So it's important that you do understand this, and I think everyone who's joined us in this webinar probably has an understanding of that. However, one of the reasons the DOL came out with this rule is the increasing complexity of these planned service relationships. And that's one of the toughest parts, is determining who's getting paid, and this is where some experienced experts can help. What we're illustrating on this graphic just shows how plan assets and employer funds might get paid to one service provider entity, and that service provider entity may then apportion some of those fees out to any number of other subsidiaries or other service providers. So it does take some work to figure out how the pricing for your plan is working. As a best practice, and one of the things that Gina just mentioned, is make a list of all the organizations that you work with. You want to be proactive in this and start asking the service providers now for their disclosures. You want to do it in writing to avoid any prohibited transactions, because you don't want to wait for July 1 hoping you're going to get these disclosures in the mail and then have your hand forced and need to terminate any relationships. So be proactive and start asking for this information now. Once you've had your list, one of the key things to understand is how are vendors typically paid for their services. On the defined contribution side, oftentimes a lot of plans are paid through revenue sharing relationships, where a portion of a fund's expense ratio is used to offset some of the costs of administration. It's a very prevalent process in the defined contribution world. There's nothing illegal about it. On the pension side, oftentimes plan assets may be used to pay for plan services. You could also have instances where the company decides to have participants share a portion of the cost, or the company itself will pay the full cost for administering the plans. Or you could have any combination of these as well. Now, Gene, if a plan sponsor is paying its vendors from corporate accounts, does it need to get these disclosures?
Well, the challenge is that this is a forward-looking disclosure. You are supposed to be disclosing what you expect to receive over the life of a contract. And just because in the past a corporation may have written a check to you as a service provider, you don't know for certain that that's going to continue. So to be conservative and to be proactive, it is important for service providers to give these disclosures to their plan sponsors. If at the end of the day the corporation still continues to pay the check, you've gone above and beyond and been very upfront about your fees to your clients, no harm done.
So now that you have your list of entities that service your plan and you have an understanding of how these entities are being paid, you're going to start getting these disclosures from them. You then need to determine, is all this reasonable? Gene, what tools does PEI offer to help plan sponsors?
Well, for the last couple of years, we have been really proactive in helping our plan sponsors benchmark their fees for the defined contribution plans, and we take a little bit of a unique approach, we think, to offering this service, in that we typically go out to market. So we would talk to you, we would sit down with our clients, talk to them about the current vendor that they have, the services that that vendor is providing, and then we would go out to a unique subset of vendors who would be good side-by-side comparisons to that client's current providers, and give you a sense of where those fees are with relationship to the market. I don't have to tell all of you, and if there are any vendors on the phone, the last couple of years on the defined contribution side, there has been a race to the bottom. Record-keeping fees are at an all-time low. But what I tell clients all the time is any given year, the pricing could be very different. It depends on who's trying to buy business maybe at that particular time, who could be driving pricing down. So that's why we do not subscribe to the concept of a huge database, because we feel it's important to benchmark your fees against vendors, similar vendors that you would like your plan to be with if you decided to leave your current provider. So there's been something in the news this week about fees, and we would maybe challenge some of these statistics that are being thrown out there, because sometimes those quotes in the paper are not only looking at institutional priced shares, but they're also looking at retail shares. And so it kind of skews it, and maybe it would give clients a sense of comfort that their fees are reasonable, but you're not really doing an apples-to-apples comparison against your plan's fees.
So let's explore some of these different methods that are commonly used for benchmarking plan fees, and Jean touched on a lot of these. A lot of times there's ample survey data out there that you could go and look and say, here's a plan similar in size to mine. What are their fees like? The challenge or the limitation when you just look at survey data is that it's impossible to account for all the variables in plan pricing. So there's a lot more to just average account balance and plan size that impacts the plan's pricing. We've also often heard of advocates that say, if you're trying to benchmark your fees, go ask your vendor what they charge other similarly priced plans. Now, one of the challenges with that is they'll tell you what they charge other plans. However, it doesn't give you any context. And as an example, you wouldn't do this in your personal life. If you're looking to buy a new television, you're not just going to go to Best Buy. You're going to look at Amazon.com. You might go to a couple different other stores. So if you're just going to your current vendor, you have no context if that vendor's fees are high or low relative to the market. That's why at PI, one of the things that we advocate is the request for information process, because it's going to be more attuned to what your plan services needs are and be more specific to you. Now, when we investigate the steps of an RFI process, let's talk about some of the things we look to do. First and foremost, we want to go to service providers whose service offerings match the services your plan needs. So not only do you have to understand what services you need, but also vendors that can provide those services. As an example, a couple of years ago, we had a client that required educational meetings in Mandarin Chinese. Only a small group of vendors could handle that. So going to vendors who can't do that really doesn't help from a fee benchmarking standpoint. You aren't going to ask a plumber to give you a quote on electrical work at your home. It doesn't make any sense. So being specific with the vendors you go to is key when you're doing a fee benchmarking study. So once you've identified your vendors and you start to get information back from them who can meet your services, oftentimes when you get the data back from these vendors, it's in different formats. And this is where an experienced expert can help, because you want to ensure that the data is in similar formats to make an apples-to-apples comparison. Now, Jean, can you speak to a little bit some of the challenges of getting pricing in an apples-to-apples format?
It's becoming increasingly more and more challenging, actually, and you would think maybe it would be getting easier. But part of the problem is, and this again refers to the defined contribution side, all vendors have different pricing models. So a vendor might be charging one client fees based on a per participant. Somebody else may be in a bundled pricing arrangement. Somebody else may be in a basis point arrangement. So when we do these, the first thing we try to do is deal with all those variable pricing models out there and try to equate them. So if you today are currently, for example, getting charged on a per participant basis, we try to get vendors to give us that pricing. Or, for example, if you're in a basis point pricing, we try to get vendors to give us that as well. But there are so many other variables out there now with respect to fees. Who might be charging now for trustee fees? We just saw a large plan provider now charge plan sponsors to offer self-directed accounts to participants. We hadn't seen those fees in the past. Those fees were typically just borne by the individual participants who wanted to be in a self-directed brokerage account. Pricing out advice is becoming a challenge as more and more plans are offering advice. Some vendors charge for advice. Some vendors don't charge for advice. Some vendors charge for advice based on all eligible plan participants. Some charge only based on the usage of your plan participants. And so it takes us a lot of work to really dig down and understand, first and foremost, where you are and what your total pricing is, and then those other vendors, what they would charge to offer you and your plan participants the exact same level of services. So again, this is why we don't like to subscribe to the survey path, because there's no way that a survey is going to be able to capture all these other ancillary fees, because honestly, as the record keepers are being pushed to lower pricing, they have to make the pricing up somewhere. And so there's a lot of new fees, and we spend a lot of time working with vendors, visiting plan vendors to try to understand their pricing models, because at the end of the day, what the goal is first and foremost, we want to make sure that our clients understand the total fees. But then our job is not to go in and beat people up. It's really to give you the sense that you have where your fees are today, are they reasonable, and how those fees might play out in the marketplace.
And as you've gone through the process, the third step is you can make that comparison. Once you've received all the data, you have it in an apples-to-apples format. Best case scenario, your current vendor's fees are right in line with the marketplace. However, as Gene has talked about, we've seen these ever-changing pricing models. Oftentimes, your current fees may be outside the market range. If it's outside the market range, it gives you that ability to then go back and renegotiate with your vendor. In other cases, you might, if your fees are so egregiously out in left field, you may decide to make a change from a service provider. And the final step in that process is, again, taking a full circle using the fiduciary process, document, so you want to be able to document everything you did through this process. So, Gene, when you do a fee benchmarking, how do you document the process?
So what we do is we spend a lot of time up front with the client to understand what's going on. We also then spend time with the incumbent, because sometimes the story, certainly the incumbent or the provider will have a different perspective on how that plan is operating. We then, as we said, go out to market. Once we collect all that data, we spend a lot of time sifting through that data, and then what we will do is then come back and sit and meet with whoever is appropriate, whether it's the benefits manager or the full committee, and we will go through explaining where the fees are today, and then go through the other list of vendors and how those fees have priced out, and then have a discussion about what the next step should be.
If you apply these best practices we've discussed, in many cases it can reap good rewards for your participants. Now, as a disclaimer, you don't get these fee reductions 100% of the time, as we've illustrated a couple of real-life case studies. However, if you apply what you learned and partner with experienced, knowledgeable experts, your chances of improving your plan pricing are improved had you gone it alone or relied only on survey data or your vendor's pricing. So in closing, before we open it up for questions and answers, the goal of the presentation was to prepare you for fee disclosure and make sure you're ready and prepared for July 1 and how to apply best practices when doing a fee benchmarking. Gene, what should plan sponsors be doing now?
Well, I think, as we said before, the first thing is to make a list of your covered service providers, and then reach out to them in writing and ask them when they are going to disclose. And if they do not feel that they are a covered service provider, then you want to get something from them in writing that says why.
And we have a few moments to answer a couple of quick questions, so please feel free. If you'd like to enter a question in the chat box, we can discuss them with you.
One question that I saw come up was, can you give an example of a non-covered service provider? And this may not be 100% of the time, but your accountant and your auditor may not be a covered service provider, because typically the services that they provide to you would not be a fiduciary status. However, a couple of caveats there, because on the defined contribution side, as Dave alluded to before, this whole concept of these ERISA budgets is as clear as mud. we're not attorneys. We would suggest that you have a conversation with your ERISA attorney to find out what their point of view is on these ERISA budgets, because there is some chatter, and again, we're not attorneys, we're just kind of relaying what we've heard, is that those could be considered, if you're paying people out of those ERISA budgets, it could be considered indirect compensation. So a provider who may not think they're covered because, again, they don't know how they're being paid, may in fact be covered under this. So again, we would suggest that you start with that list, understand how they're being paid, and then talk to counsel if you have any questions at all. And again, really the onus is on them, not you, because if you've asked them and they come back to you in writing and say, we don't feel that we're considered, you've done your part. If they are not complying with the regulation, they have a pretty hefty excise tax. So I think that for a lot of providers out there, this has started a discussion that maybe they didn't necessarily think they were going to have.
And another quick question that come in terms of copy of the slides. These will be distributed to all the attendees after the close of the presentation.
And I see another question out there about the participant fee disclosure. So remember, there are two separate fee disclosures. This is the fee disclosure under 408B2. This is the plan sponsor fee disclosure requirements. The participant fee disclosure is a whole different webinar, but I think that that's another thing that you probably want to talk to your record keeper on. When are they going? Have they given you a sample of the participant fee disclosure, and when do they plan on sending out? We know, for example, that Fidelity has started sending out those fee disclosures to participants. They've been sending those out for a while. We know other providers are not going to start sending those fee disclosures to participants until July and August. So I think you need to go back to your provider to find out where they are in the process. We are looking through some questions as we speak.
I think we have time for maybe just about one more.
Okay. Just looking. Go up. Do we have an obligation to disclose with specifically DB participants? There's no, so there was a question about disclosing to participants in a DB plan. The participant fee disclosures are only for participant-directed plans, so that would not cover a defined benefit plan. This is, however, this 408B2 is for any ERISA plan, so 401k, profit sharing, pension, money purchase, and ERISA 403B plans. If you have a non-ERISA 403B plan, you are not covered under this. We are not, service providers don't have to comply with this regulation.
Thank you, Dave and Jean. If your question was not answered during the Q&A session, the answer will be distributed along with the recorded presentation. Please feel free to contact Dave or Jean after the event should you have further questions. Thank you.